Imagine receiving money on a day when you did not go to work. No extra shift, no new client, no overtime. You wake up, check your account, and discover that something you own has earned money while you were asleep. That sounds like a fantasy. Online, it is often sold like one. Buy this course, copy this secret strategy, create passive income in 7 days. But real wealth does not work that way. There is no magic asset that produces large returns with no work, no capital, and no risk. But there is a powerful principle that wealthy people understand. At first, you work for money. Then you use some of it to buy assets. Eventually, those assets begin working alongside you. In this video, we will examine 7 assets that can grow in value or produce income when you are not actively working. And the final asset has the greatest potential of all, but also the one cost that most passive income videos conveniently ignore. Meet Rich Stick and Poor Stick. They earn the same salary, and each has $200 left at the end of the month. Poor Stick sees $200 he can spend. Rich Stick sees a tiny employee he can hire. Poor Stick upgrades his phone and buys things that feel rewarding today. Rich Stick is not against enjoying life, but before spending everything, he asks one question: can some of this money buy something that may pay me back? 1 month creates little difference, repeated for years. Poor Stick collects expenses, while Rich Stick collects ownership. That is the real meaning of making money while you sleep. Your money, property, ideas, or systems continue doing economic work after your personal workday ends. So let us climb the ownership ladder. The first asset is a bond. When you buy a bond, you are lending money to a government, municipality, or company. In exchange, the borrower promises interest and the return of your principal according to stated terms. Treasury bills are short-term United States government securities. Treasury notes and bonds have longer maturities, and notes and bonds generally pay interest every 6 months. This is the least exciting asset on our list. That is why it matters. Bonds can provide income, reduce some portfolio volatility, and give money a job while it waits for a future purpose. But safer does not mean risk-free in every sense. Bond prices can fall when interest rates rise. Corporate borrowers can default. Inflation can reduce what fixed payments can buy, and selling before maturity may produce a loss. For Rich Stick, bonds are not a shortcut to riches. They are the stable floor beneath the next layers. The second asset is a broad market index fund. Instead of trying to predict which single company will dominate the future, an index fund can give you small ownership stakes across many companies. That matters because a stock is not merely a number moving on a screen. It represents ownership in a real business. When those businesses grow and become more valuable, long-term shareholders can participate. This is where compounding becomes powerful. Suppose Rich Stick invests $200 every month for 30 years and earns a hypothetical average return of 7% a year. He contributes $72,000. But the account could grow to roughly $244,000 before taxes and fees. The extra growth comes from returns earning returns of their own. It is not guaranteed. Markets fall, returns arrive unevenly, and fees matter. Money needed soon should not be exposed to stock market risk. But for a patient investor with a long horizon, diversified index funds can turn consistency into ownership at enormous scale. The third asset is shares in dividend-paying businesses. A profitable company can reinvest its earnings or distribute some cash to shareholders as dividends. That payment can feel like a small paycheck from a business you partly own. But this is where Poor Stick makes a dangerous mistake. He searches for the stock with the highest dividend yield and assumes the largest number means the best investment. It does not. A very high yield can appear because a company's share price has collapsed. The business may be struggling, and the dividend can be reduced or eliminated. Dividends are not free money. They are only one part of total return. Rich Stick studies the business behind the payment, its cash flow, debt, competitive position, and history of sustainable distributions. Or he uses a diversified fund rather than depending on one company. The goal is not the biggest payment this quarter. It is durable ownership for many years. The fourth asset is a real estate investment trust, usually called a REIT. A REIT is a company that owns or finances income-producing real estate. Depending on the REIT, that may include apartments, warehouses, healthcare facilities, offices, hotels, or mortgages. Publicly traded REITs allow an investor to buy a small share of a real estate portfolio without purchasing an entire building or answering a tenant's call at midnight. REITs can distribute income, and their shares are usually easier to trade than a physical property, but they still carry risk. Property values and rents can fall. debt can become expensive. Some sectors can suffer from vacancies or changing consumer behavior. Non-traded REITs may also be difficult to sell and can carry substantial fees. Rich Stick does not buy a REIT simply because the yield looks attractive. He checks what properties it owns, how much debt it carries, whether the dividend is supported, and whether the investment is publicly traded and liquid. The fifth asset is rental real estate. Here, you own the property directly. A tenant pays rent, and the owner hopes that the income remaining after all expenses becomes cash flow. The words "after all expenses" are important. Poor Stick calculates the rent, subtracts the mortgage, and calls the difference profit. Rich Stick also allows for vacancy, repairs, insurance, taxes, management, utilities, legal costs, and large future replacements such as a roof or heating system. Direct real estate can offer income, appreciation, and control. Borrowed money can magnify both gains and losses. One purchase can concentrate substantial wealth in one building and neighborhood, and rental property is not automatically passive. It becomes less dependent on your time only when the numbers can support reliable systems and management. The asset is not simply the house. The asset is a property that produces durable net income after realistic costs. The sixth asset is intellectual property and digital products. This can include a book, music, photography, software, an online course, a template, a design, or another original work that people can buy or license repeatedly. Unlike a physical item, a digital product can often reach the next customer at very low additional cost. You do the difficult creative work once, then it may continue selling. But upload does not equal income. Most products disappear because nobody needs them. Nobody discovers them, or the creator never improves the offer. Rich Stick starts with a specific problem, builds for a defined audience, protects his rights, creates distribution, and updates the product when needed. Your first digital asset does not need to be huge. It could be a practical spreadsheet, a classroom resource, a niche guide, a useful design pack, or a small software tool. The principle is simple. Create value once, then build distribution that can deliver it many times. The seventh asset is a systems-driven business. This has the greatest potential to separate income from personal hours. It also requires the most work, judgment, and risk. A self-employed person may own a job. If they stop working, the income stops. A business becomes an asset when customers, processes, technology, brand, and a capable team can create value without the owner making every decision. It could be a service company with documented procedures, a software business, an e-commerce brand, or a local operation run by trained managers. But there is no switch that turns a new business into passive income. At first, it may demand more time than a job. The goal is to replace improvisation and dependence on one person with repeatable processes. Poor Stick asks, how quickly can this pay me? Rich Stick asks, how can this keep serving customers without depending entirely on me? That is the difference between owning your work and building an asset. So which of the seven should you buy first? Do not choose the most glamorous asset. Build in layers. Layer 1 is stability. Create an emergency reserve. Eliminate destructive high-interest debt and protect money you cannot afford to lose. Layer 2 is compounding. Automate regular contributions into a diversified, low-cost portfolio appropriate for your time horizon and risk tolerance. This is where consistency can quietly do the heavy lifting. Layer 3 is controlled expansion. After the foundation is sound, use your capital, skills, and available time to explore assets such as direct property, intellectual property, or a business, and apply 4 questions before buying anything. What exactly produces the return? How much work will this require? How can I lose money? What is the smallest responsible way to begin? If you cannot answer those questions, you do not understand the asset yet. And never confuse passive income with guaranteed income. Promises of high returns with little or no risk are classic warning signs of fraud. Years later, Poor Stick may still have a collection of things he bought. Rich Stick has built a collection of things that can pay him. He did not become wealthy in his sleep. He became wealthy by using some of his waking hours to build ownership that continued working after he stopped. You do not need all 7 assets. You need a strong foundation, one sensible starting point, and enough patience to keep adding ownership over time. Which asset are you building first? Write the number in the comments from 1 to 7 and tell us why. In the next episode of The Ownership Ladder, we will expose 7 things people call assets that may actually be keeping them poor. Subscribe to Rich Stick, Poor Stick, and continue building wealth, one wise decision at a time.